Mutual fund taxes refer to the taxes investors owe on the income and gains they earn from their mutual fund investments. These taxes are based on dividends, capital gains distributions, and profits from selling shares. Understanding how mutual funds are taxed can help you plan and minimize your tax burden. How are mutual funds taxed? Mutual funds generate income from dividends, interest, or profits from selling securities in their portfolios. This income is passed on to investors and taxed based on the type of distribution. Dividends. Qualified dividends. Taxed at lower long-term capital gains rates if they meet holding period requirements. Non-qualified dividends. Taxed as ordinary income at your regular income tax rate. Capital gains distributions. If the mutual fund sells securities for a profit, the gains are distributed to investors. Short-term gains. Taxed as ordinary income. Long-term gains. Taxed at lower capital gains rates. Selling your shares. If you sell your mutual fund shares, you'll owe taxes on any profits. Short-term gains. If held for less than a year, taxed as ordinary income. Long-term gains. If held for more than a year, taxed at lower capital gains rates. Example of mutual fund taxes. Let's say you invest $10,000 in a mutual fund and receive $200 in qualified dividends, $300 in short-term capital gains distributions. Later, you sell your shares for $12,000, realizing a $2,000 gain. Your tax responsibilities would look like this. $200 taxed at lower capital gains rates, qualified dividends. $300 taxed as ordinary income, short-term gains. $2,000 taxed based on whether it's a short or long-term gain. Tax-advantaged accounts versus taxable accounts. Tax-advantaged accounts, e.g. IRAs, 401ks. Mutual fund earnings are not taxed until withdrawal. Withdrawals may be taxed as ordinary income or tax-free Roth accounts. Taxable accounts. Dividends and capital gains distributions are taxed in the year they're received. Profits from selling shares are taxed based on holding period. Tips to minimize mutual fund taxes. Choose tax-efficient funds. Index funds and ETFs often have lower turnover rates, resulting in fewer taxable capital gains. Use tax-advantaged accounts. Invest in mutual funds through IRAs or 401ks to defer or eliminate taxes. Harvest losses. Offset capital gains with losses from other investments to reduce your taxable income. Reinvest wisely. If you reinvest dividends, track your cost basis to avoid overpaying taxes when you sell. By understanding how mutual fund taxes work, you can make smarter investment decisions and avoid surprises during tax season. Proper planning helps you keep more of your hard-earned money while growing your investments.